Hi everyone. Today we're going to be talking about how you can profit from realized volatility. In particular, we're going to learn about this new asset class, how we as investors can invest in it, and what possible trading strategies are out there. Just to provide a bit of motivation for how realized volatility works, I've started with this picture, which is the Great Wave off Kanagawa. In this scene, the fishermen are rowing back to what is now called Tokyo against the waves to deliver live fish to their market. And us as investors, we also have to brave the waves of the financial markets in order for us to exact a return. And often it's very scary, and we have to huddle and cower before the large forces that affect us. This is a video that I made, a GIF video, and you can find it on my website, fully available, to provide a bit of motivation as to what exactly is volatility, what is it that people are talking about. And as you see here on this little line, volatility is how quickly the movement of a financial market or an instrument moves over a period of time, how jerky it is. And as you see here, the hotter the color, the higher the volatility is. And I just made this in my computer using R. It's really important to note that as the color gets darker and it gets redder, the movements, they become more erratic and they become much larger. That's really what people intuitively mean by volatility, is very large erratic movements over time. Here's a bit of background. Volatility refers to the change in a measure for a given period of time. Here's a graph to help you understand exactly what I'm referring to. Let's say that we have this measure, and the measure here is all these dots. They're dotted out. These are what we see. We know that time, it moves linearly, that is 1 second, 2 second, 3 second, in a constant pace. When we're talking about volatility, we're talking about the deviation of our measure, which is all these dots, from a long run time average, as you see here with this big black line. And what we're referring to as volatility is this blue arrow here, which is this dot, which differs from where one would expect it to be, considering the long-run relationship between the measure and time. We can measure volatility in financial markets, and this is how it's commonly done in two different ways. The first way is to do realized or historical standard deviation as a percent of price. This is often called realized volatility, which is the subject of this presentation. Realized volatility or historical standard deviation looks at the standard deviation, which is the second moment of the data, and actually takes all this information here and calculates it into a key statistic, which is the standard deviation, to measure what the volatility is. Another way is to look at implied volatility, and this is the expected volatility or the market's best guess as to what volatility is based on market option prices. Due to the ubiquity of options, implied volatility has become the dominant means in financial markets to trade volatility. This includes the popular VIX index, as was introduced in 2004 by the CBOE. Implied volatility, however, has properties that really make it an imperfect measure, or a measure that investors that aren't as sophisticated or don't have the substantial resources that investment banks and hedge funds do may want to make them wary of this measure. It is well known in financial literature that there's a positive bias in implied volatility relative to real or actual volatility. That is, if you look at the predicted volatility by the market and compare that to the actual volatility, which can be defined as the standard deviation, that happened after that expectation or after that prediction, you'll see that it actually has a positive bias. That is, investors, based on option values, expect more volatility than what actually happens. Another issue with implied volatility, and this is more of a technical issue, is that there's a lot of illiquidity in out-of-the-money options on the underlying asset. To help you understand what exactly I'm referring to here, implied volatility, the way it works is that based on some well-known theoretical relationships between option values and their underlying price, one can derive the implied volatility or the value of that option that's attributable to the change in the price of the underlying, the variability of that change. The way this happens in practice is market participants will actually collect option data and apply calculations to infer the implied volatility. However, because those measures are illiquid, and this is in particular to out-of-the-money options, because out-of-the-money options actually have a much better gauge of volatility than in-the-money options. The reason for this is that if one looks in the Black-Scholes formula, one can see that as an option becomes more and more in the money, it replicates the value of a forward or a futures contract. However, as an option gets more and more out of the money, the value of that option becomes much more skewed towards volatility. And that means that out-of-the-money options are the most valuable when one wants to infer implied volatility. However, those out-of-the-money options, because they're so volatile, one could argue, they're very illiquid, and it makes measuring implied volatility a very difficult task. Another issue with implied volatility is that it's far more volatile than realized volatility. That is, the market's expectations as to what implied volatility or what volatility could be in the future is very, very inconsistent and very, very erratic. This is a very undesirable property from an investor or a portfolio manager's perspective, because this irritability or this change in the volatility means that it's very hard to create tactical, long-run portfolio positions. Another issue with implied volatility is that it's often wrong. That is, often the markets will expect far less volatility than actually happens, or sometimes they'll predict far more volatility than what actually happens. And this is arguably one of the least disagreeable problems with implied volatility, is that it doesn't work sometimes. It just doesn't gauge it always right. Another issue is that implied volatility is asymmetric for different asset classes. Equities, for instance, they only have upside because in bankruptcy the equity holders do not lose money. Bonds, they bear the opposite. Bonds bear the downside. And because those asset classes are asymmetric, options on those asset classes that will provide you with implied volatility are also asymmetric. And they can give you an asymmetric or a non-parallel response to changes in implied volatility. Well, here's a proposition. Considering that we know so much about implied volatility, why not trade realized volatility explicitly? This way we can get a pure exposure to volatility. There's no gamma hedging. And when I refer to gamma hedging, I'm referring to the fact that when someone trades implied volatility, that is, when they're taking a position on implied volatility, there's the issue of gamma. There's the sensitivity of the option value to changes in the delta, which is the sensitivity of the option to the underlying. That is, when you're hedging implied volatility, you have to be sensitive to changes in the sensitivity of the option to the underlying. And this gamma hedging is actually very difficult, and it's part of what makes options a realm of very sophisticated investors. However, if we trade realized volatility, we won't have any of those issues. Another is that it ignores microstructure. One can just look at the actual standard deviation, or the actual change of the underlying over time, and create a value. You don't need to mess around with microstructure in that case. Another advantage is that it's cheap. Because it could be measured as an index or just a key parameter, one doesn't actually need to have some arbitrage of the underlying. You can very cheaply collect realized volatility, analyze it, and display it to as many participants as possible. Another advantage of realized volatility is that it's really simple. You could go on Excel and recreate it yourself, and those advantages are really nice when we're talking about retail investors or investors that simply do not want incredible amounts of complexity when they're trying to make a trading decision. It turns out this idea is already done at the institutional level. There's a very liquid over-the-counter market in realized volatility and variance watch, which are just realized volatility squared. This market has been especially active in currencies and equities, and it's been going on for over a decade. Retail investors have not had market access to this until now. Just before we continue, I'd just like to recap on what we've learned. We've learned that there are two different measures of volatility. One is implied volatility, and the other is realized volatility. Realized volatility, which most people refer to, refers to the actual change in a measure over a given unit of time. Implied volatility refers to the market expectations of what that change in measure will be in the future. When looking at both measures of volatility, one can see that implied volatility has features that do not make it as useful as realized volatility for the individual investor. It's very illiquid, it's very complex, and it's not very transparent. Also, it has a disadvantage that it's not very consistent and doesn't necessarily track what investors really believe volatility is. The proposition that I'm bringing is, why not trade realized volatility explicitly for the individual investor, for someone like you or me? It will get pure exposure, it's cheap, it's simple, and institutional investors have been doing this for a very long time. Well, it turns out that this has already been done. In February 2011, the CME began trading realized volatility futures on the Euro-USD futures price. It settles on 1-month historical volatility. There's also a 3-month settlement. However, for this presentation, I'm focusing on the 1 month. This is the formula that the CME uses to settle their contract. Here, as you can see, the realized volatility is just the change in price, that is, the current price over the previous price, and you log it and you square that. You sum it up over the entire relevant period and divide it by 252, because that's the number of trading days in a year. And you square root the difference. Instead of getting realized variance, where I talked about variance swaps earlier, we get realized volatility. And they multiply by 100 to rescale it, to make it more easy to understand. Each contract is traded on a $1,000 multiple of 100 basis points in realized volatility. This is a really nice feature of this contract. It makes it very friendly to the end user. If I have any questions about what the contract is, 100 points in realized volatility, let's just say that there's 19% volatility that's realized over that period. That's 19%, that's 1900 basis points, and you times it by $1,000, it's $19,000 per contract. Here's an example of this. Let's say that on March 16th, by the way, these are all real numbers, in 2012, I sold 5 realized volatility contracts at $10,790 per contract for June settlement. Then what I did is I took the realized volatility from the 14th of May to the 7th of June, and I saw that it was 8.32%. The gross gain from my trade, because I sold it higher than what it ended up being, was $10,790 minus $320 and multiplied by 5, because that's the number of contracts that I traded, for a net gain of $12,350. Obviously, this excludes commissions, taxes, and so forth. Right here is ultimately what I want to demonstrate when I'm talking about this contract, and this is actually a very beautiful picture. At the top here, what you have is the actual realized volatilities futures contract for the underlying 6-month Euro USDFX future. And the different colors correspond to the different maturities at the different dates. Blue is January, red is February, green is March, black is April, and so forth. One thing that I would like to note is how beautifully this contract flows. That is, it's very much like an ocean and waves. If you remember back to our introductory slide, you can see that there's large forces that come down, and then they come up, and then come down again. Another interesting issue that one can see from this is that there's no obvious structure to the futures. Sometimes it's in backwardation, where the current price is larger than the future price. However, sometimes it's in contago, where the future price is higher than the current price. This is intuitive for 2 reasons. When someone sells a future, they have to hedge. However, with realized volatility, the cost of hedging is just holding the futures contract itself. There is no underlying, unlike in gold or in a physical commodity, when one actually, to hedge, actually has to store that commodity and bear those costs and all the liquidity that comes with it. Because this is just a future and its underlying is an FX contract, hedging this has no natural cost. It's just the cost of me bearing that risk. That's why in this case you see some large fluctuations in the structure and the shape of the curve. Down here I have the value of the underlying of the Euro USD spot. And as you can see, over this period it went from $138 per euro to $1.23 per euro. That is an increase in the value of the dollar and a decrease in the value of the euro on a relative basis. One can see here that in the beginning, or in this period from November 3rd, 2011, while the euro was high, there was a very high implied volatility in the market. But as the market kept on going downward in a downward trajectory, the realized volatility fell down, as here. However, at some junction, which is May 1st, 2012, the market did not expect for the exchange rate to continue dropping. It expected something else. However, when it kept on dropping at this rate, the implied volatility shot up, which is very interesting. It shows you how the interaction between market expectations, realized volatility, and the underlying. And one can infer very interesting narratives out of this. A natural question to ask is, okay, Alon, we have this future, we have the underlying, and if you remember, if we'll go back here, you can see we have the underlying here, and we have the futures contract on the volatility. How can I use this to take a position? What is a hedge? What combination of both the volatility and the underlying should I do? For those of you who are more financially educated, you'll be aware that the minimum variance hedge is based on a relationship between the standard deviations of both assets and their correlation. In this picture here, I did a rolling measure of both volatility of both assets, that is, the volatility of realized volatility itself and the volatility of the euro-dollar relationship. And I looked at correlation. I wanted to break the components of that equation to two parts: the correlation and the ratio between the volatilities. As you can see here, the volatility ratio between the realized volatility of the euro-dollar and the euro-dollar itself is very constant over time. It has peaks, for instance, up here in May. However, overall, if one looks at not just long run average, but also on a monthly basis, and even on a weekly basis, it generally tends to revert back to mean. That is, it reverts back to some underlying long run constant. This is a very nice, attractive feature. This tells us that us as investors or us as traders who we want to take a position, if we measure the ratio between volatility and the realized volatility and the volatility of the underlying, and use that to base our position, we can hold this relatively constantly without having to constantly rebalance. However, if we look at correlation down here, we see a very different picture. What we see is that the correlation is changing very constantly over time, and it's very erratic. It's almost a mean reverting strategy. Its long run average is 0. However, it can go from very high, for instance 60%, down to very low, to minus 60%, in the course of about a week. It then tells us that when we're trying to create the minimum variance hedge, perhaps we should take the correlation, because if you remember we have the ratio of the variances and the correlation as both components in the equation. Maybe we should not just use correlation. Maybe we should exclude it because it changes so much and it's so variable over the trading period. When we test this strategy, this is the result. If we look at the tracking error of a proportional volatility hedge between long realized volatility and the euro dollar, which is the position, just for example, that we take, we can see here that both the quarterly, the monthly, and the weekly track each other very closely up until May 2012, from which then they start to separate in their performance. What one sees very interestingly is that the monthly hedge tracks the weekly hedge very, very closely. And if we'll go back to that slide here at the top, one can see that it's because of this peak here in May that we had that tear right here. However, after that tear, what we see is that the quarterly rebalancing, it doesn't track very well. However, the monthly one tracks quite well the weekly one, which given that there are costs to hedging, including trading costs, liquidity, and so forth, it shows that holding a monthly position or using a volatility ratio as the amount that we'll need to rebalance every time is a reasonable proxy for trading. This is the result that we get when we actually take a position where we short volatility and short the euro, or we just short the euro entirely. If you could remember back to your previous slide here, we'll see that let's say you were sitting here and you thought you shorted the euro. You thought that it could go down. However, the euro could have gone up. If you were sitting here and you decided, well, I think it may go down, but I want to hedge just to make sure, what you'll do is you'll short the euro, you'll short realized volatility. And as you can see here, when you short the euro and you short realized volatility, you enhance the value of that trend. That is, if you just shorted the euro around January 2012, you would start to lose money until March. That is, if you started here and you shorted the euro, you would actually lose money. However, if you shorted volatility and you shorted the euro, you would accentuate that trend and you would have a long run gain in your performance. This is a really attractive feature. This is all using a simple ratio between the volatilities of the different assets. That is, if you just take the volatility of realized volatility divided by the volatility of the asset, or in this case, the euro dollar, find that long run relationship, hold them in equal proportions, and rebalance the aggregate size just to make sure there's no leverage, this is the position you get in comparison to a shorting euro dollar position. You can accentuate your trend, which is a really attractive feature. Another advantage of realized volatility is that it provides portfolio protection. In this case, instead of the investor going short both volatility and the euro dollar, let's say that this time they want to protect themselves. This time they went short realized volatility and long the euro dollar. If they just long the euro dollar, as you remember back to our previous slide, the investor in the long run would have lost money, especially if they went in this position. However, if they had shorted volatility and long the euro dollar, while they would have lost money, they would have actually made money by late March, early April in that position. And if they just held it on, using this hedge, they would have made money. This is a really nice feature of realized volatility, and this is all using very simple ratios and very simple calculations, and all based on your position that you want to go long the euro dollar. An advantage of realized volatility, and this slide is simply a previous slide, but enhanced, is that it is uncorrelated with the underlying. That is, the correlation between realized volatility and the euro dollar is very limited. And that means that over the long run, you can use this as a hedge when you're making positional bets on the underlying. And as you can see here, it's actually very, very volatile. There's huge movements in the correlation between returns. That is, the correlation between betting on the euro dollar and betting on realized volatility over time. On the long run, it goes to 0. However, over the short run, it's incredibly erratic, going from 80% to minus 70%. The natural question to ask is, okay, given that I have realized volatility and it's an interesting asset class that I can incorporate into my portfolio, is there potential for equities? That is, FX is very nice, but most investors, they have much more experience with the equity markets. What I did in this picture is I took the realized volatility of Apple stock and replicated a realized volatility future, quote unquote, and compared it and did the exact same exercise that we did earlier with the actual realized volatility futures. And as we can see here, we actually have a very different picture than what we had earlier with our realized volatility futures. Instead of waves that come and go, we have this canyon or almost building-like structure where there's huge shifts upwards and downwards in the realized volatility with very long plateaus. This indicates that the equity markets, their volatility actually operates very differently than volatility in the FX markets, and may change the value to us of using a strategy that combines both realized volatility and the underlying asset when making our positions.
If we look here, we can look at how, as opposed to the currency markets, in the equity markets, the dynamic between realized volatility and the underlying is actually a bit different. In fact, these two instruments are actually highly correlated with each other, as opposed to the previous case where they were non-correlated to each other. That means that if we want diversification benefits, we have to short one and long the other to get the opposite relationship. In this case, as you can see here, when we short volatility and we long the underlying, or long Apple, we actually accentuate or build in leverage into our investment. In this case, the short volatility long Apple actually does better than the long Apple in the bullish period, which is here from about April 2012 to October 2011. However, in a bearish market, or when things aren't going as well for this particular stock, or in this case Apple, we're going long Apple, it actually does worse, which is the case from April 2012 to July 2012. This shows that the benefits to equities from pursuing this strategy aren't as great as they are for currencies. That's probably one of the reasons why CME did not start with the realized volatility in equities, but instead chose a currency instrument. This position, however, still has the advantage of reducing the variance of your portfolio if you're making a position on the underlying. For instance, if you were short Apple in this case, here, and that was your perspective, you would have lost money over that same period. However, if you shorted volatility and shorted Apple, you could have actually reduced slightly your variance because the correlation between both instruments isn't perfect. It still would have moved in your overall direction, however, it would have reduced the volatility of your position. And as you can see here, while it went down, it didn't go down as much as for Apple. The biggest reason for this, and we can see this in this story here, is that the correlations between realized volatility and the underlying for equities are much, much more erratic than those for the currency markets. If you can see here, the correlation between realized volatility and Apple are actually very, very highly structured, and where they get is sudden breaks. It's very high at about 70%, and it moves around a lot. So it sinks and then it rises, sinks and then it rises. And this reduces the value to the investor from pursuing a strategy where they have both realized volatility and the underlying in their portfolio. If you look at the volatility ratio, it's actually quite similar to that of the currency story. You have large peaks, but overall you have a very long run average. This indicates to us that it's actually the correlations that's driving this relationship and that behavior, whereby choosing a strategy which has both volatility and the underlying isn't nearly as beneficial in the equity markets as in the currency markets. Just to recap what we've learned so far, we've learned that what volatility is, that it's an instrument that bets on the change of a measure over a period of time, that this instrument exists. The CME has been producing this instrument. This instrument has the advantage in that, unlike implied volatility, it is based on the actual variability or the rate of change in the underlying over time. It is cheap, it is simple, and it is effective. And for the currency markets at least, it is highly beneficial in both accentuating trends and providing portfolio risk in case of bad movements. However, when we apply the same techniques to the equity markets, we see that it isn't nearly as beneficial. The main reason for this is the relationship in the correlations between realized volatility and the underlying in equities. In this case, you don't have a zero correlation with very long variability. In fact, you have quite a persistent high-end correlation that is subject to sudden jumps. This reduces the value to the investor of pursuing such a strategy. However, in the future, as this instrument is available to the retail investor in the commodity markets and the fixed income markets, I would expect that one would see other instruments besides the euro dollar where such a strategy would be beneficial. These are the references here that I used, and I'll put them on the YouTube channel that I used to create this presentation. They were highly beneficial. The slide deck that I used to create the charts as well as the calculations is available on my website. And you're welcome to email me with any questions you have about any of my methodologies or strategies.